What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are looking at the fact that there are a lot of people out there, some big names, who are calling for, some of them, the biggest stock market crash of our entire lives. Not only that, they're saying that this is inevitable and it will happen soon, and many of them are saying even by April. A lot of this is paired with deflationary language as well, like there's going to be a big deflationary deleveraging, a big deflationary collapse. People like Jim Rogers, Harry Dent, Dave Hunter, and many more are saying that we are in for a massive financial collapse. So today we're going to break it down, look at it to see if there's any merit at all to these claims, and if so, what can be done to prepare for it. Ready? Let's dive in. All right, so there's two key things to remember here before we really jump into the details. Number one, everybody has different definitions for things. So when you talk about inflation or deflation, when you talk about a crash, when you talk about deleveraging, when you talk about growth, a lot of times these are words that carry a lot of either baggage or different definitions. Like for instance, inflation, deflation, you could be talking about the money supply. You could be talking about the general level of prices like the CPI. You could also be talking about the general, the total value of all assets in the world, the global financial markets. When you talk about growth, you could be looking at GDP, you could be looking at productive output, you could be looking at a lot of things. And so that's the first thing to keep in mind, that when you're hearing some of these people make these massive claims about a giant stock market crash or something else, you have to figure out what are the underlying assumptions or the definitions that they're actually using, because a lot of people say the same words but mean completely different things. The second thing to keep in mind is, it's quite surprising actually, that many of these people who are calling for a giant stock market crash, they're kind of arriving at the same conclusion but from very different angles, and have gotten there through very different approaches. Like they might disagree on how it actually unfolds, but the ending result maybe being a giant stock market crash, 60, 70, 80, 90% is something that there's a fair amount of consensus on. So what is causing all of these people to say that we're going to have this giant crash and this giant deleveraging? The main thing that pops up in these arguments across the board is the general level of debt around the world. When you look at the debt to GDP ratio, when you look at the amount of debt that governments have, when you look at the amount of debt that the economy has, like actual corporations versus productive output, or when you look at the total level of debt carried by all the stocks on an exchange versus their market value or their earnings, pretty much no matter how you look at it, our world has really never been as leveraged up as it is today. Now, the reason why this is significant is because we just went through kind of a financial crisis, right? When COVID hit and triggered kind of a very quick collapse and recovery, at least in financial assets, there was no deleveraging. And historically, and when I say historically, I mean hundreds of years, historically, when there are financial collapses or when there are big catastrophes in markets and economies, you have deleveraging events. But this time there was no deleveraging. In fact, it was the opposite. There was an explosion of debt. So why is deleveraging something that is important? Well, it's kind of like the traditional saying that the recession or the depression is the cure for the malinvestment. In economies that are debt-driven economies, you have something that is typically called the business cycle. It's really not a business cycle. It's a debt cycle where you have an expansion of the total money supply, which causes a lot of money to rush into ventures and business activities that are not sustainable. And it looks sustainable because you have really fantastic amounts of growth in certain isolated areas, but really that's just a result of the new money that has come into the system through that credit expansion, bidding up the prices of whether it's assets or certain goods, causing a false mania or a false boom that when that reverses itself, it collapses and it fixes the fact that there is all this malinvestment in the first place. Do people lose their jobs? Of course. Do people lose incomes? Absolutely. Do financial assets collapse or at least in isolated areas of the market, like let's say the dot-com bubble? Absolutely. But it's like a forest fire that goes through and clears out all the dead wood. And everybody else who is doing business properly that survives, like Warren Buffett always says, it's not until the tide goes out that you see who's been swimming naked. At this point, when you see something like this happening, like a big deleveraging and a deflationary collapse, what you see happening is that all of the businesses and people who relied on more traditional financial, just the basics, right, of not being too over leveraged, actually caring about things like earnings, those businesses survive. And then since they survive, they end up just by, being the ones left over that end up being stronger. They can then purchase the assets at a cheap price from all the companies that went bankrupt. And so all of the healthy companies are able to absorb a lot of the business capacity that was going into these businesses that were really destroying capital. And so there's a short-term bust, but it's healthier long-term. Well, what happened last year was none of that. Obviously, it was very front and center that there were tons of businesses getting bailed out all across the economy that were actually, probably shouldn't have been bailed out. A bunch of companies just given government money in order to keep on limping along. And yes, there's short-term pain, but long-term, if there's still demand for that product or that good or that service, even those people that lost their jobs, they'll still be able to work in the same industry because those other companies would get larger. They'd have to absorb the extra capacity. And if the demand is not there, yes, those specific job losses are permanent, but overall for an economy, that's actually the better thing to happen because there aren't resources being forced by coercion to be allocated to specific areas that there's no demand for, meaning that it's actual destruction of capital in a society. Okay, so we didn't get any of that. Instead of having a deleveraging, we levered up. And on top of that, it wasn't just debt. Just as a side note, the world is more levered up than it's ever been through the use of derivatives. So even just discounting all of the debt, there's a lot more leverage in in the global economy through the use of derivatives than there ever has been. This sets up for a very fragile system where one thing going wrong can bleed over and spill over and start knocking things over like dominoes. Especially financial institutions like banks whose balance sheets are levered up sometimes 10 to 50 to 100 times what their total market cap is. Now, another factor that people point to in terms of the fact that we're, probably headed towards a massive crash is simply valuations. When you have valuations as high as they are right now, you just simply don't have that much room left to run. Now, you know me personally, I'm still expecting a big run up in asset prices, but with the expectation that that is some sort of a melt up or a blow off top or a crack up boom as coined by Ludwig von Mises. But valuations, yes, that is actually a really big problem. When we look at pretty much any metric we have available to determine what's the value of a business, it's hard to find a time in history when more businesses have been more overvalued than they are right now. And that indicates that we're somewhere near the end of a massive amount of money running into these assets because at some point, money has to chase value. At some point, money can't just participate in a scheme in which the only way prices go up is by more money coming in. At some point, if that's all there is driving prices up, then that dynamic has to reverse itself. Which brings us to the third point that a lot of people are saying is a real negative for our economy coming up is spending. We're probably going to start to see some sort of a boom as economies open up and some of the pent up demand where people want to go out and do stuff and places start opening up again and money starts getting spent from, especially all the people that have the money to spend, start spending it. And so it'll look like things are starting to take off in the right direction. But in an economy that relies on debt and spending for ever increasing growth, that is not going to provide enough. As we know demographically, especially in the States, there's just not enough new money and there's not enough growth to support the spending needed further extend that growth. Especially when you consider who has most of the money, it being the boomers, and the fact that as this continues, there's going to have to be more and more drawdowns from retirement accounts, which if you've seen my video on passive investing and the index fund bubble, you know that being reversed and that thing switching over from, net inflows to net outflows, that alone could trigger a stock market collapse. And the fact that there's a giant wealth gap between, let's say, millennials and the baby boomer generations, that the amount of growth that's going to be able to be brought about and caused and then therefore spent by millennials, it won't catch up for years, potentially decades, to the shortfall that we're about to start seeing from baby boomers. And so with just these combination of events, massive leverage through mostly debt but also derivatives, historical valuations of asset prices at all-time highs no matter how you want to measure them, and then a spending problem where there's just not enough money to be able to spend to support prices. It indicates that there's a potential for what we've seen over the last 6 months or so, big rise and big shoot up and big pop in prices across the board to start to collapse. But even further than this, since this is classified as like a deleveraging, This is a deflationary event. This is a deflationary collapse because as asset prices tumble, debt starts to tumble, defaults start to happen across the board. There's layoffs, there's income drops. It's a giant cascading snowball effect of deflation across the board. Much of the money that's in the system is not actual, dollars or currency units. A lot of the money that's in the system is debt. Quite honestly, most of it. And so as that starts to collapse, whether you're saying inflation and deflation is a monetary event of the total money supply increasing or decreasing, or whether you're saying inflation and deflation is prices, whether it's, again, assets or goods and services, no matter how you define it, kind of the outlook here is that it's all going down. Now, I don't necessarily disagree with this. In fact, I think the probability of something like this happening is fairly high. And you might be shocked to hear me say that simply because you know how much I've been talking about recently, how I think we have inflation in front of us. And I do think there's more of a likelihood of that. But the reason why here that it sounds like I'm ascribing a fairly high amount of likelihood to a deflationary collapse type of event, it all comes down to one thing. And it's the main difference. It's really the only difference between the views of people who are saying that we're going to have a crash versus saying that we're going to have, a melt up. So the main difference here is how much will central banks be able to absorb. Now, the requirement on central banks to absorb this in order to keep all of these prices, whether it's debt or financial assets, whether it's stocks, whether it's real estate, whatever it is you're looking at, the amount of collapse really that they will have to absorb by purchasing bad assets as other people are selling them could very well be into the hundreds of trillions globally. So the real differentiating factor between those who say we're going to have a crash versus we're going to have a crack up boom is what is the capacity of the central banks, and not even the capacity of printing, right? Because that capacity is theoretically or technically it's unlimited, right? The Federal Reserve is currently purchasing $80 billion a month of treasuries, $40 billion a month of mortgage-backed securities. Overnight, if they wanted, they could double, triple, quadruple, 10x that. Because all they're doing is typing numbers onto a computer in order to create bank reserves. So that's not the issue. The capacity that I'm talking about when I say the capacity of central banks is really the fortitude of those in charge. And in a lot of places, it's also the political gridlock, because many times you need conjunction between the central government and the central bank in order to have a massive increase like we had last year, $3 trillion all at once, expanding the Federal Reserve's balance sheet. You need normally some sort of coordination, and you need it to happen fast because stock markets can crash like that. Now, we know that Janet Yellen being in charge of the Treasury has, there's a lot more ability for conjunction, for coordination between the Federal Reserve and the Treasury. So we know that is in place. The second thing is we know now that the Federal Reserve has the ability to navigate around the Federal Reserve Act, and Congress historically has been perfectly okay with that. By law, the Federal Reserve is only allowed to purchase two things to hold on their own balance sheet, and that's treasuries and mortgage-backed securities. But over the last year, they bought a lot of other things that they're not expressly allowed to buy, like corporate debt and junk bonds. Now, how did they do that? There were special purpose vehicles set up at the Treasury in order to make these purchases, and they were funded by the Federal Reserve. And so it would be very easy to set up one more SPV at the Treasury that's made for purchasing ETFs, equity ETFs specifically. So we have historical precedent for the Federal Reserve opening up channels in order to allow all of the toxic assets from wherever they are around the world to flow onto their balance sheet. It would just be opening up one more little window to do that with stocks instead of just debt. And that will be where the next problem is. So really the only disagreement is, do central banks have enough capacity and enough fortitude and enough coordination with their central governments in order to do this at the same extent or significantly enough so in order to absorb all of the selling, so that as people like you and me and as institutions and as hedge funds and as mutual funds and whoever it is out there that is selling stocks keeps on selling, all of that, they're basically all just selling to the Federal Reserve. So that's the question, and that's the only question that matters here, and that's the only thing differentiating these two opinions on whether we're going to have a crack up boom or a deflationary collapse, is how much will central banks monetize. Personally, I think the likelihood is more on the side that they will monetize. We might have a smaller crash first, like probably not 90%, but I would not be surprised at all to see something like a 20% crash before they step in and start doing this. In fact, that's one of the things that I've said for probably since November. That's one of the things that I expect to see this year, actually, is the Federal Reserve stepping in and buying equities. Now, here's my final thoughts. It doesn't actually matter. You still have the same effect because all of that loss is still happening somewhere. It only changes where it shows up, whether it shows up in prices of assets or whether it shows up in the value or the purchasing power of the dollar. Because if the Federal Reserve monetizes the entire collapse and absorbs it all with, let's say they print 20, 30, 40, 50 or 100 trillion or whatever it has to end up being, that just means it has that direct impact on the purchasing power of the dollar. You're sacrificing the purchasing power of the currency on the altar of keeping financial asset prices elevated. This is the same thing that John Law did 300 years ago in France with the Mississippi bubble. He had the Mississippi Company, and the shares that he issued were the shares, that was the asset that backed up the currency that was the national currency. They were a monopoly. It was a fiat currency. Fiat currencies are nothing new. And so that currency was backed by this company. Just like today, we have a currency that's backed by treasuries. And in order to keep the asset price, the Mississippi bubble shares, elevated, John Law had to keep on printing money to purchase shares. Just like today, in order to keep the asset prices like treasuries inflated at the levels they are, the Federal Reserve has to keep on printing money to buy these treasuries. Now, what happens in the end is that everybody realizes that there's only one buyer, and so everybody sells at these elevated prices to get some purchasing power while they can. And that's what people did in France. They all sold their shares of the Mississippi Company because there was a buyer who was printing money, and so they got to sell it at elevated levels, and then they went and purchased things like gold and silver and real goods and real products. And from the time the collapse started, it was only about 9 months to the point where that currency, John Law's currency, no longer had an exchange rate on the market anymore. It was worthless. Nobody wanted it. Now, it's likely not going to unfold exactly like that, but you get the point that I'm trying to make, that nothing we're seeing today is new. And number two, in real terms, the same thing happens. You still have a collapse. It just changes where it shows up depending on how you measure it. And so either financial assets, and really assets everywhere, we have a big deflationary collapse, or the purchasing power of fiat collapses. Now, here's the one thing that does change for your investing in your portfolio. Is cash versus gold. If we have inflation, cash is the worst thing to hold. If we have deflation, cash is the best thing to hold. So cash, its purchasing power, is volatile depending on the environment that we are facing. Gold is the same. You might see a collapse in the price of gold, going from like 1,800 to let's say 1,000. But if that happens, the prices of everything else will also be collapsing. So you're either going to preserve or gain a little bit of purchasing power in gold, just like you do during inflation. You don't really make a ton of money during inflation by holding gold, but you do preserve your purchasing power. That's why for any items that are not impacted by technological deflation, just things getting cheaper over time due to progress in technology, you can look back at thousands of years of history and they cost the same when you look at, how many ounces of gold it costs to purchase them. And so holding cash right now is a risky bet, because you're betting on the fact that the Federal Reserve won't just continue to do more of what it's done in the past. But it could have a big payoff to where if everything gets really cheap, cash would be the only thing that would go up in value relative to everything else. And even though the price of gold would collapse, the value or the purchasing power would stay the same or potentially even slightly increase. Because if gold falls by, let's say, 30 or 40%, but everything else falls by 40 or 50 or 60 or 90%, then you actually came out ahead, even though the price dropped. Yes, cash would be more, but that's why it's a higher risk to reward bet right now, because you're again betting on the central banks around the world to stop doing what their only job is to do and the only thing they know how to do. Now, if you're interested in learning how to use options to speculate on either a crash in the stock market or in a giant crack up boom, I have both a beginner's and an advanced options course that I've created. They're both linked in the description below. Also, next Wednesday, we are starting the live stream Q&A that will happen monthly for members only. So if you haven't already, you can sign up. You can join with the join button next to the subscribe button or in the link in the description. And for $25 a month, you can join my monthly live stream Q&A. It's a small group. It'll be very conversational and it'll be primarily driven by you guys, where you ask questions and we have discussions and conversations about it. If you don't want to sign up for that, don't worry. Nothing about my channel is changing. That's just a new thing that I'm doing. doing on top of these videos. As always, I really appreciate you guys. Thanks so much for watching. Have a good day.